Welcome to this White Coat Investor real estate presentation. I'm here today with Elaine Staggerberg, who is not only a doc, but the CEO of Black Swan Real Estate and has been sponsoring the White Coat Investor now for a number of years. Welcome back to doing another presentation here for us here at the White Coat Investor, Elaine.
Yeah, thank you for having me. Excited to be here today.
As with most of these presentations, we're going to start with Elaine's presentation, and then we will move into kind of a Q&A period and have more of a discussion, more of a conversation about the opportunities available through Black Swan. So let's turn the time over to you to get started.
Yeah, thank you. Thank you so much, Jim. Thank you for that introduction. I'm excited to be here. As you mentioned, I'm Dr. Elaine Staggerberg. I'm a psychiatrist by training, had the really great fortune of training at the Mayo Clinic in Rochester, Minnesota. And you'll see that's where the extreme majority of our real estate portfolio is located. And over the years, right from when my husband and I first got married, we started investing in real estate. And then we just continued to grow that portfolio organically, started working with passive investors in 2016. And today we own and operate Black Swan Real Estate, and we have an investment offering called the Secure Freedom Fund that I'll share all of the details with you about. And then at any time, if anyone wants more information about the Secure Freedom Fund, all of that can be found at securefreedomfund.com. The Secure Freedom Fund is a Reg D 506C offering, which means it is available to accredited investors only. And then a usual disclaimer with any investment presentation: this is privileged and confidential information. It's forward-looking information. All investing does have risk, including the potential for failing to hit targeted returns, loss of capital. Everyone is encouraged to contact their own advisors, like a financial advisor, attorney, CPA, as they're making any investment decision. So by way of a little bit more of a thorough introduction, here's a picture of my husband, Nick, and I. We've built Black Swan Real Estate together using our own capital over the years. And then, as I mentioned, started working with passive investors a number of years ago. We've been married for 15 years and we've been investing for 15 years. Our very first investment was just a few months after we got married. We have 5, soon to be 6 amazing children. We like to say we like to do everything at scale. We really thrive in a growth-oriented, kind of chaotic environment. And we see that in the scale of our business and then also in the scale of our family. I'm a psychiatrist by training, and my husband, Nick, is a software architect by training. Both of us now dedicate our full time to Black Swan Real Estate. Nick for about the last 7 years, myself for about the last 6 years. But really, as we built the company, we took the professionalism and the values that came from medicine and from software and brought it into real estate investing, which in many ways is a much more naive, unprofessional industry than medicine or software, and have found that by bringing that level of professionalism into this different industry, it's allowed us to create a really amazing company with a great track record. Our investment arm is called Black Swan Real Estate, and then we are vertically integrated, which means we not only own all of the assets in the portfolio, we provide all of the asset management and the property management directly through our sister company, Black Swan Living. And when we think about what our mission is, we think that our mission is really to make the world a better place to live in the most tangible sense of the word. Largely because of the 2008 economic crash and so many builders leaving the industry, the United States is really in a housing crisis. There's just simply not enough housing to go around for everyone. And we feel like this is our unique place to contribute to creating housing, creating affordable housing, renovating housing, providing a really high quality living experience. And then doing all of that in the setting of working with our passive investors. So to date, we've had nearly 600 passive investors, many of whom are physicians, many of whom are not, but probably about 65% of our investor pool in total are physicians. And we like to see how we're able to bring together our investors and their dollars and helping them to create passive income and financial freedom, and doing so while creating the thing that we all need the most in our lives, which is a place to live. A little bit about the scale of our portfolio. We now have about 450 million in assets under management as of early 2026, and that number is ever growing. I mentioned we have about 600 passive investors. We've raised about 115 million of capital over the years. And all of that is in about 2,300 units that are managed by Black Swan Living. We really believe in real estate investing that operations is everything, that so much is driven by the team that's running the properties, making the decisions in terms of marketing, leasing, management, maintenance, capital expenditures, renovations, improvements, customer service, you name it, that whole life cycle. That's where the value is created in real estate. And so all the way back to our very first asset ever, we've always self-managed and believe that that's something that separates us from many other general partners or passive investment opportunities, that we directly are stewarding the capital that's placed with us and making the day-to-day decisions in terms of the management of those assets. We also have a fairly large real estate sales team so that we're always in the market. We always have a beat in the market. We've done about 210 million in lifetime sales. And then we do some ground up construction as well. So we've built about 50 million of new housing. We've built a townhome community, several apartment buildings. We've done what's called an adaptive reuse, where we converted some commercial space into residential units, and really enjoy doing that work and helping to, chip away at that housing crisis that our country is in. And then the investment offering that we have available right now is called the Secure Freedom Fund. Again, I mentioned you can take a look at all of the details at securefreedomfund.com. And what I'm going to do here in our time together is right here on this slide, I'm going to summarize basically the entire structure of the fund in just a few minutes. And then as we go through the rest of the presentation, I'll dive into each of these bullet points with a little more detail, share information with you about the portfolio that's held in this fund and other things that are important for you as you're learning about this investment. One of my favorite things about the Secure Freedom Fund is that it's really easy to understand and it's really customizable to the investor. So most of what I do in Black Swan Real Estate is working with our investors, talking with them one-on-one, meeting them at conferences, hearing about their needs, and over time, taking the information that I hear from our investors and crafting our investment offering to uniquely meet their needs. And what I've heard time and time and time again from investors is every investor, every family has different financial needs and different financial goals. And so as we created the Secure Freedom Fund, we basically thought through all of the variables that are in a passive investment offering and thought, how can we push that lever so that the investor has as much flexibility as possible? So we'll go through those here. The first choice in the Secure Freedom Fund is to choose the investment amount. Our minimum investment is just $25,000, and then you can invest in $1,000 increments thereafter. You choose the vehicle that you would like to invest in. So what that means is you can invest as an individual, you can invest jointly with a spouse or a partner, through an LLC, through a trust, or through a self-directed retirement account, such as a 401k or an IRA. And then you select your strategy. So the Secure Freedom Fund is a 10% fixed return offering, and you can choose either to receive monthly distributions if what you're prioritizing in your financial picture is cash flow. Those are processed on the first of each month, and they're direct deposited directly into your bank account. Or if what you're prioritizing is a higher overall rate of return, you can choose the compounding option, in which case your earnings each month are just reinvested back into your investment account and they compound monthly. And we'll talk more about the compounding option a little bit later here. And you can choose either of those options, either monthly distributions or monthly compounding. There's also quite a bit of flexibility with exiting the fund. So that's called requesting a redemption. And when an investor would like to exit from the fund, you request a redemption, and those are processed in a first come, first serve, best effort basis. And again, we'll go through the more finer details here in just a few slides. And then what we do with these dollars at Black Swan is we use these dollars for the acquisition of real estate assets. I'm going to describe for you the assets that are already in the fund and what our target assets are for future acquisitions in the fund. And it's that ownership of those assets in the fund that generates the return that goes out to investors. So we use these dollars for the acquisition, renovation phase, if there's any physical improvements that are needed for those properties, and then to operate those assets over time. And then because the fund is an equity fund, which means the investors in the fund have an ownership stake in the assets that are owned by the fund, that means that investors benefit from the tax advantages of direct real estate ownership. It's taxed on a K1 and includes depreciation and other powerful tax advantages. And we've really given a lot of thought into tax optimizing the fund as much as possible because we know that's so important to high income earners to not only have an optimal rate of return, but to keep as much of that return as possible and pay as few taxes as possible. So here in the next several slides, I'm basically going to dive into each of these bullet points, but provide a little bit more detail. The first one is the investment amount. That's the simplest decision in the fund. The minimum investment is $25,000. Then again, you can invest in increments of $1,000 thereafter. You invest however it best fits you. So you can do individual, joint, LLC, trust, self-directed 401k, or self-directed IRA. All of those are entity types that can invest in the fund. There's a little bit of a different paperwork for each of them, but a fairly straightforward process for each of those investment types. And then really the biggest decision for investors to make is how you would like to receive your returns. You can receive monthly distributions if passive cash flow is your main goal, or you can allow those returns to compound, in which case they compound monthly. So essentially, instead of that return getting direct deposited out to your bank account, it instead just gets automatically reinvested into your investment account, and then you're earning return on that return. It's important to note that your capital begins earning a return the day that it's deposited, and it continues earning a return until the day the funds are returned to you. So there's no downtime in your capital working for you. Many funds that are structured similarly to ours might have even like a 60 or a 90-day period at the front end or the tail end where your capital is not yet back in your possession and yet it's no longer earning a return. And we've structured ours so that you know from the day your dollars are in the fund until the day your dollars are returned back to you, they're earning that return the entire time. Let's take a look at the examples of some numbers here. So in the next two examples, I have one that's the monthly distribution option, and then the other that's the compounding option. And both of these are based off of a $100,000 investment. So with a $100,000 investment, that would earn a 10% fixed rate of return per year or $10,000 per year. And you would receive that in monthly distributions. So that $10,000 divided by 12 is an $834 distribution that's direct deposited to you on the first of each month. And your first distribution is prorated based on the day your investment is deposited. So because you're earning return from that very first day, if you invest on, say, the 15th of the month, you would get a distribution for the remaining 15 or 16 days in that month. And then the subsequent months after that would be the $834 distribution on the first of each month. Pretty easy to calculate. You would just take your investment amount, multiply it by 10%, divide that by 12, and that would be your monthly distribution amount. Many of our investors choose the compounding option because they're looking for a higher total rate of return. And maybe at that phase of their life or their career, they're not prioritizing cash flow and they're instead prioritizing their overall wealth creation. Here is the compounding table based on a $100,000 investment. So you can see after 12 months of compounding, the effective annual return goes up to 10.47%. So instead of an investor receiving $10,000 in that first year, they receive $10,471. And so their capital balance at the end of the year is $110,471. And that additional $471 comes because they've been then earning the return on the monthly returns that are reinvested back into the account. Warren Buffett says compounding is the eighth wonder of the world. And the compounding really becomes powerful over a number of years. So after 2 years, the effective return is 11.57%. After 3 years, 12.78%. And then on from there. And you can see how the capital balance would grow over time. So this is a much more beneficial option for investors who don't necessarily need passive cash flow at that stage of their investing journey, prioritizing an overall higher rate of return, and then prioritizing longer term kind of set it and forget it wealth building. At any time, investors can log into our investor portal. We use the platform called Invest Next and see the accrued preferred return. So here's an example that I did a screenshot from one of our investors. So you would be able to see as that's growing each month to get some sense of the balance of your account. You just log into the account and it's right there on the investment screen. Let's dive into a little more of the details around exiting the fund. This process is called requesting a redemption. And this is a place that we've tried to give investors as much flexibility as possible and make this a really straightforward process. So when an investor would like to exit the fund, you simply let us know that you would like to redeem your shares by reaching out to us via email. If you're able to provide us with as much notice as possible, that's helpful. And in the next slide, I'll talk about some of the constraints on liquidity in the fund. Redemptions are processed on a first come, first served, best effort basis. So what that means is when an investor requests a redemption, we process those as they come in. And that best effort basis means that we are constrained by the amount of liquidity that's in the fund. So because real estate is generally an illiquid investment, we're using these dollars for the down payment and the renovation for the assets that are owned by the investments. We aren't necessarily able to guarantee that we would always be able to do a redemption. That's why providing as much notice as possible is quite helpful so that we can plan for the liquidity needs in the fund. That being said, in our history, we've always been able to fulfill redemption requests in about a 7 to 10 business day period. There's a little bit of paperwork back and forth. And then after that, we're able to deposit those funds back into your bank account. The more advanced notice you're able to give us, the better. And particularly the larger the amount that you have invested that you would like to redeem, more advanced notice is helpful. Even if someone said, something like, I'm going to invest now, and in 2 years, I plan to redeem my shares, we keep notes of that so that we can plan for those liquidity needs in the fund. I do want to call out that because real estate is at its core an illiquid investment, we want to make sure that investors aren't treating their investment in the Secure Freedom Fund, similar to like a bank account, right? We want investors to have the ability to do a redemption when they need to, while also recognizing that investing should be more of a long-term thing. So if an investor needs to redeem in the first year, you would surrender any of the preferred return and you would have a return of your principal, similar to, say, cashing out a CD at a bank early. We've had a few investors over time that say have had an unexpected health change or perhaps a change in their marital status or that sort of thing and have needed to redeem within the first year, and we're able to honor that. After that first year, a redemption is business as usual. And if you were receiving your monthly distributions, you'd get your final monthly distribution and then your return of capital. If you had been compounding, you would receive back your original invested amount and then all of the growth that had accrued. I just want to make sure we talk just one more time again about a note on liquidity. So your investment in the Secure Freedom Fund is different than, say, a deposit that you have at a bank where you can freely deposit and withdraw from that account. real estate at its core is an illiquid investment. And so while we do maintain liquidity in the fund and we strive to get those redemptions out as quickly as possible, a redemption is never guaranteed. If for some reason there were too many redemption requests at one time and we didn't believe that the fund had enough liquidity to safely honor all of those redemptions, we would honor those in a first come, first serve basis, and there could potentially be a delay with that. Historically, that's never happened, but it is important for investors to know that your access to the capital, while we endeavor for it to be as flexible as possible, it is different than, say, capital that you have, liquid in a bank account or a general savings account. A couple of other ways that investors can choose their own adventure and that we've built flexibility into the Secure Freedom Fund is that investors can add to their investment when the fund reopens. So what I mean by that is the Secure Freedom Fund is not necessarily just open all of the time. We open when we get a new asset under contract and we're raising the dollars that we need for the down payment and potentially the renovation for that asset. And then we close the asset, we close the fund, we close on whatever that asset is, and then that process repeats itself over time. When we have a new asset under contract and we're again raising capital for the fund, the first investors who have the opportunity to invest in that time is existing investors. So we reach out to all of our existing investors in the fund and ask if you would like to add to your position. Because you've already surpassed the $25,000 minimum, you can add to your position in increments of $1,000. So we have lots of investors that might add, say, 5 or 7 or 10,000 several times per year as we get new assets under contract, and you don't need to hit that $25,000 minimum each time. So it's a way to just kind of slowly build your investment account over time as we get new assets into the fund. There's also the ability to switch between monthly distributions or the compounding option if your financial goals change. You just email us, let us know. It's a simple one-page document that we sign, and then we get that switched over on the first of the next month. And then one of the things that's really quite interesting about the Secure Freedom Fund is many of our investors will hold multiple positions at once. So what I mean by that is, for example, an investor might have some dollars in, say, a self-directed retirement account. And because they can't access those dollars anyway, because of the age restrictions on retirement accounts, they may choose to have that investment using the compounding option so that they're getting that higher growth over time. And then also have a position in the Secure Freedom Fund using their personal post-tax dollars from their checking account. And with those dollars, they may prioritize getting passive cash flow into their household. And so they'll have the monthly distribution. So we have several investors that have several different positions, kind of targeting different financial goals that they have in their overall finance picture. And it's an interesting way that you can use the fund to target multiple different financial goals that you have. And then also in terms of your redemption, you can process either a full redemption, which is where you receive all of your return of capital plus any growth that is due to you, or you can do a partial redemption so long as you leave behind the $25,000 minimum. As an example of that, we recently had an investor who had $250,000 invested in the fund. He needed $200,000 for the acquisition of a personal home. So he did a redemption for $200,000, left behind $50,000 in the fund so that $50,000 could continue to grow. I hope you see here how with each of these variables, as we created the fund, we really put a lot of thought into creating an opportunity for investors to get the benefits of real estate investing, the diversification and the tax benefits that come from real estate investing, while also making it as flexible as possible with each of the various levers that are there in your investment opportunity. I think of the Secure Freedom Fund as a fixed return offering, and it's good to compare it to other fixed return offerings. You can think of the Secure Freedom Fund as, say, similar to a CD or a bond, but with higher returns. You might also think of the Secure Freedom Fund as similar to an annuity in that it has the option to produce monthly cash flow for you. But typically, an annuity dies when the account holder passes away, whereas with the Secure Freedom Fund, even if the account holder passes away, your shares are completely inheritable by your heirs. So these are some numbers that I pulled just a couple of days ago in February 2026, looking at other fixed return offerings. So a 10-year treasury bond is currently paying 4.21%. CDs are paying about 4% right now. Money market accounts are anywhere from low threes to low fours. And then the Fidelity short-term bond ETF is 0.34%. The Vanguard short-term bond ETF is 5.32%. So that gives you some sense of investment offerings that are a fixed return offering, kind of similar to the Secure Freedom Fund, different risk profiles, of course, but gives you a comparison to the typical rates of return that you might be able to receive with a fixed rate of return offering compared to the 10% rate of return that's available in the Secure Freedom Fund. And then, of course, we have to address taxes. Taxes are so important for high income earners who are, typically paying very high percentages of their overall income into taxes. Because the Secure Freedom Fund is an equity fund, which means it has direct asset ownership of the apartment communities that are owned in the fund, you'll receive a K1, not a 1099. So even though the Secure Freedom Fund maybe feels like a debt fund, if you're familiar with that concept, a debt fund investors would receive a 1099, which is typically taxed at ordinary income rates. Because this is an equity fund, investors receive a K1, and that allows them to participate in all of the tax advantages of real estate ownership. Depreciation is the biggest tax advantage for real estate ownership. 100% bonus depreciation was written back into the tax code as of 2025. So what that means is that we as general partners do cost segregation studies, bonus and accelerated depreciation. We work closely with our tax team to optimize the tax losses that we're able to share out with our investors so that you're deferring your taxes as much as possible. We've also structured the fund so that your gains are treated as long-term capital gains as much as possible, which is about half of the tax rate compared to ordinary income. Now, there's some returns in the fund that say, for example, we keep the liquidity in the fund in a high yield savings account, and there's interest that's generated on that. And all of our investors get a proportional share of that interest allocated to them as part of your 10% rate of return. So not all of the returns are taxed as long-term capital gains, but we've really structured the fund to push as much of the return into long-term capital gains to minimize the tax burden as much as possible. Tax optimization is easier to achieve when you choose the compounding option, because in the early years of your investment, you'll be receiving depreciation on your K1. You can use that depreciation to either offset other passive gains that you have for maybe other real estate or passive investments, or you just carry it forward on your tax return each year until you are able to use those passive losses. And then when you have the redemption in the compounding option, that's when you would have a taxable event. So it's a little bit more tax efficient with the compounding option. And then the longer you stay invested in the fund, the more we can maximize the tax efficiency. So let's take a look at numbers here, the power of after-tax returns. So if we look at, say, a CD that pays a 4% annual rate of return, that would be taxed at an ordinary income rate, which for a high income earner might be around 37%. So the after-tax rate of return would be about 2.5%. In the Secure Freedom Fund, if an investor chose to use the compounding option and they invested for 1 year, the yield would be 10.47% over that first year. And the long-term capital gains tax rate is about 20% for high income earners. So the after-tax rate of return is about 8.38%. So you see there that after-tax rate of return is a really important number. So not just looking at the top line rate of return, but factoring in the tax treatment of any given investment that you're considering. And then it's even higher when depreciation is factored in, because you're deferring taxes for as long as possible and you're able to use your passive losses to offset passive gains. That's a little bit about the numbers in the Secure Freedom Fund. Let's turn our attention to some stories about real investors who have invested in the Secure Freedom Fund and why they made the choice to invest in the Secure Freedom Fund. So this is a story. I use the names Todd and Joan. That's not their real names. That's not a picture of those actual investors here. But this is an actual story where the facts of this story are investors who are in the Secure Freedom Fund. This was a person who was a spouse of a physician who had retired with a pension paying $2,000 per month, and that pension would end upon death. That person then received a very concerning diagnosis with a limited lifespan and was deciding what to do in terms of continuing the pension, knowing that the pension would end upon his death, or cashing out the pension, which had a value of $400,000. At $400,000, a pension cash out would mean that they would be able to receive about $1,600 per month if we assume a 4% drawdown rate. So it would be a significant hit to their income because they were used to receiving about $2,000 per month from the pension. So instead, they chose to invest in the Secure Freedom Fund. So they took the $400,000, invested it into the Secure Freedom Fund with the cash flow option, which would then generate $40,000 per year in return. Divided by 12 is $3,333 per month in that monthly distribution. So not only did they increase their monthly income from $2,000 to $3,300, upon their passing, their wealth didn't vanish. So whereas with the pension option that would have ended upon this person's death, with Secure Freedom Fund shares, just like any other asset that you hold, it's passed on to the surviving heir. So that surviving partner continues to have the $400,000 of shares in the fund, and then also they're continuing to receive the $3,333 monthly distribution. So that's one example. Here's another example of an investor making a decision to invest in the Secure Freedom Fund. So this is an oncologist in Florida who is looking to replace his W-2 income in a 10-year period. And as I was having phone calls with this investor, he really honed in on the number of wanting to invest $444,000 in the Secure Freedom Fund using the compounding option. Typically, investors invest in increments of, say, 10,000 or 25,000 or 50,000. So in the course of our conversation, I asked, where did you come up with this number, 444,000? And he explained to me that he had projected out that with the compounding option in 10 years, his investment was projected to grow to $1.2 million. And then at that point, he would switch to the monthly distribution option, and that would generate $10,000 per month in passive income for him. Those are some examples of real investors who have chosen to invest in the Secure Freedom Fund. And you can see there how their financial goals are very different from each other. And you can think back to the various levers that investors can choose for flexibility in the fund and think about how you can apply your own financial goals to investing in the Secure Freedom Fund. Let's talk about how we put these investment dollars to work. You've heard me say throughout the presentation that the Secure Freedom Fund is an equity fund, which means it acquires and owns real estate assets directly. It is not a debt fund. That's really important distinction. A debt fund, there's several different layers of separation between the investor and their dollars and the asset. So with a debt fund, someone like myself, a general partner, would raise capital and then loan that money to another general partner, and they might have a first lien position or a promissory note, but they don't own the actual asset that's generating the return for investors. In the Secure Freedom Fund, because it's an equity fund, the Secure Freedom Fund owns the assets directly. It's the only owner of the assets in the Secure Freedom Fund. It's also important because of the tax advantages that we talked about a couple of slides ago. We then execute a value add strategy, which is different for each asset. For some assets, that might mean deep physical renovations. For other assets, it might mean management improvements. And then all of that day-to-day operations is managed by our in-house property management company, Black Swan Living. When we think about investing, we think a lot about downside protection. So I've described for you the projected investment return profile in the Secure Freedom Fund. And any investor is wise to be thinking about downside protection as well. So how do we safeguard investor capital in the Secure Freedom Fund? The first is that the fund owns real estate assets directly. We acquire with a margin of safety through conservative equity positions and then doing our value add improvements to increase the value of the assets inside of the fund. We think a lot about debt at Black Swan Real Estate. We favor secure debt instruments, fixed rate of return debt. You've seen in the real estate industry over the last several years, because of the changes in interest rates, there's been a lot of volatility in real estate investing. And we've been shielded from that at Black Swan Real Estate because we've made the decision through the entire history of our portfolio to prioritize favorable secure debt, which typically means that we're getting long-term fixed rate debt. I've talked about our Black Swan Living team and vertical integration. And then it's also important to note that in the Secure Freedom Fund, we have no GP fees whatsoever. So we have no acquisition fee, asset management fee, capital event fee, all of the fees that might take value out of the fund that then passes that risk on to investors. We don't have any of those fees in the fund. There's also no ability in the Secure Freedom Fund for there to be a capital call. So you never have to worry that you would get an email that says that there's risk in the fund and therefore you need to invest more to defend your position. One of the exciting things to share is the portfolio that's owned by the Secure Freedom Fund. So I have some pictures to share with you. Right now, in early 2026, the portfolio that's owned by the Secure Freedom Fund is Northern Place Apartments, Meadow Park Apartments, Rainbow Plaza, Commerce Drive, Northern Hills Apartments, Villages at Essex Park, some single family homes. And then we are always adding new acquisitions to the Secure Freedom Fund. So as I mentioned, when we get a new asset under contract, we open the fund, we raise the capital that we need to acquire that asset, then we close the fund, we close on that asset, we stabilize operations, and then we repeat that process over and over. When an investor invests in the fund, they get their proportional share of all of the assets that are currently owned in the fund, and then all of the future assets that will be owned in the fund as well. And it's this portfolio that provides the security that's backing the dollars that are placed in the fund, that's generating the return through either cash flow or harvesting of equity from these assets that allows us to service out that 10% rate of return to investors. So these are pictures of the assets that are owned in the fund. And then we'll do a few more pictures here of some of the amazing assets that are owned in the fund. Our most recent acquisition is Villages at Essex Park. This is the largest asset that's currently in the fund, 288 units, a $40.4 million purchase price. And we were able to acquire this community with a HUD loan assumption at 2.18% with 37 years left on that note. So it's exceptionally favorable financing that shields us from any risk, not just in the current interest rate environment, but for the next 37 years that we'll be able to benefit from that 2.18% interest rate on that loan. This community is a mix of market rate units and affordable housing units, 50% of each. We closed on this asset in December of 2025. And this asset is just 8 minutes from our Black Swan Living headquarters and just 7 minutes from our personal home. Our kids actually play soccer in the soccer fields right across the street. And I mention that because it's somewhat rare for general partners of a portfolio of this size to be so physically closely located to their assets. But because we believe that operations are everything, we've principally built our portfolio in Rochester, Minnesota, or in Greater Minnesota. That's just about an hour or so from our headquarters. And we take that day-to-day management of our portfolio very, very seriously. This is a beautiful community. It has a pool, a clubhouse, a fitness center, a playground, beautiful walking trails around a retention pond. It's a 17-acre campus with 27 buildings. So it feels low density. There's beautiful trees everywhere, lots of open space on the campus. And then it's also physically adjacent to Rochester, Minnesota's largest sports complex. You can see the aerial map here. On one side of the community is the largest soccer fields in town. And then on the other side is a large baseball park. And so the community benefits from this vast green space that isn't owned by the community. So the city is maintaining these sports complexes, but the residents who are living in this community get that peace and quiet and that kind of secluded nature that comes from how the parcel is located. Meadow Park Apartments is an acquisition that we had in early 2025. We've done a very large renovation at this community. We've invested about $3 million of capital into this community. And you can see here the afters that we have of some of the units. We've done new flooring, new kitchen cabinets, countertops, plumbing fixtures, appliances, light fixtures, essentially trying to touch most of the things in each of the units and the common areas, doing an exhaustive exterior renovation, replacing the roofs of these 3 buildings. And so you can see here, even from Villages at Essex Park to Meadow Park Apartments, each of the assets that's owned in the Secure Freedom Fund gets a little bit of a different business plan depending on what that asset needs to do well. Oftentimes it is deep physical renovations. Many times it's management improvements. It's almost always some combination of those two things. And this creates some diversification within the fund, all the while creating that high quality housing that generates return for our investors. Here's Rainbow Plaza Apartments. This is what I would consider to be working class, B-class housing, great community, simple place for people to live. Northern Hills Apartments, we acquired in Q4 of 2025, 32-unit Class B apartment building. This one did not need much renovation. Really, the value add plan here is from management improvements, bringing laundry into the units, allowing pets in this community. And that gives you some sense of the assets that are currently owned in the fund, and then also the types of assets that we're targeting for the future. Even as we record this webinar today, my husband, Nick, my business partner, is doing unit walkthroughs for what we're hoping will be our next asset in the Secure Freedom Fund. So we're always growing the Secure Freedom Fund as well. Investors have a lot of choices as you're making your investment decisions. And here are some of the reasons why investors choose the Secure Freedom Fund. We have a very unique investor first structure. So as I mentioned, we have no general partner level fees whatsoever. We have no capital calls, and your returns begin the day your funds are deposited, and then they continue until the day your funds are withdrawn. And then as you've heard from the Secure Freedom Fund, a big component of the Secure Freedom Fund is your ability to customize it to your own financial goals. In terms of our track record, we've been investing for 15 years. Our portfolio is about $450 million in assets under management. We value a long-term hold. We have never sold an asset that's owned by Black Swan Real Estate. We've never lost money on a real estate deal, and we've never missed a projected distribution. We focus on blue ocean markets, principally Rochester, Minnesota, home of the Mayo Clinic. Coincidentally, it's where my husband was born and raised. And then we came back here for me to do my training at Mayo Clinic in residency, and then built our portfolio here. We focused on fixed rate debt for stability, and we're vertically integrated with Black Swan Living. Throughout the history of investing and working with passive investors, we've had consistent performance, 0 losses. We've offered a similar fixed rate of return offering since 2018. We've never missed a preferred return payment. We've never failed to honor a redemption, which is a return of capital when requested. We've never lost money on a real estate deal. And then we matured that offering into what's called a Reg D 506C fund in 2024. That's when the Secure Freedom Fund was created so that we could publicly market this offering and welcome passive investors into it. And we did that because of overwhelming investor demand and feedback for the offering. So to learn more about investing in the Secure Freedom Fund, you can see all of this information in the how-to instructions at securefreedomfund.com. If the fund is open at that time, you'd be able to go through and start your investment. If the fund is closed at that time, you can place your name on the wait list to know when we are open again. Your questions matter. We're here for you. Most of what I do at Black Swan Real Estate is work directly with our investors. There's a QR code here. You can block a one-on-one call with either myself or my husband, Nick. You can reach us via email, nick@blackswanteam.com or elaine@blackswanteam.com. We endeavor to be very reachable and look forward to hearing from you if you have any questions. And then I also just want to introduce you to our Director of Communications, Rachel Bernard. She helps with things like paperwork, setting up your commitment, working in the investor portal, InvestNext. She's here to make the investing process very simple for you. If you need any technological help as you're making your investment, and you can reach her at rachel@blackswanteam.com. That is a summary of the Secure Freedom Fund and about us here at Black Swan Real Estate. You can see all of this at securefreedomfund.com. Reach out if you'd like to schedule a one-on-one call or have any questions.
Okay, thank you, Elaine, for the presentation. All right, let's get into some of the questions. And, it's my job to ask all the hard questions here. And so we'll get into some of those. But let's first talk about how large is the fund? I mean, how much equity is there in the fund today?
So the fund as a whole is a $100 million fund. To date, we've raised about 35 million of that 100 million, and that has been used to acquire a portfolio valued at about 90 million. So we will continue to grow the fund for the next several years until we hit the 100 million of capital raised, which will be placed into about 400 to 450 million of assets when we factor in the mortgages that we're able to get as well.
Okay. Can we talk about the investors in the fund? Obviously, they're all accredited investors.
Correct.
Can you give me any sense of what percentage of them came in at a 25,000 like amount versus a six-figure plus amount?
Our average check size in the Secure Freedom Fund is $78,000. We have a handful of investors that have invested multiple millions in the fund, a larger handful that have invested $1 million in the fund. And then I would say the majority of our investors have invested somewhere around, say, 75 to 150,000, with the average check size being 78,000, and then a large handful at 25,000 as well. So it's pretty evenly distributed across the investment amounts, but there's a bucket at the lower end at 25,000, and then a select handful of investors that have invested a larger amount of capital as well.
Yeah, I think the presentation mentioned a total of 600 investors in the past. How many of those are actually in this fund, approximately?
I don't know that exact number off the top of my head of how many individual investors are in the fund, but there's been 35 million of capital raised into this fund, and in the entire Black Swan portfolio, 115 million of capital has been raised. So about a third of the capital that we've ever raised has been raised into this fund.
Okay. And in the fund currently, there's 6 apartment complexes and approximately how many single family homes?
Just a few. There's like 3 single family homes in the fund right now. Single family home market is pretty challenging. Many people know that pricing has continued to go up for single family homes, despite the fact that interest rates have also gone up. So in the future, if the single family home market shifts and it opportunistically makes sense to continue to add to the single family home portfolio, we would absolutely be open to doing that. Right now, the economic dynamics work much better in multifamily housing. So the fund is the extreme majority multifamily housing.
Okay. And let's talk about the leverage in the fund. What is the loan to value ratio of the properties in the fund, and how much of that is fixed?
So all of the debt in the Secure Freedom Fund, 100% of the debt is fixed debt. The average loan to value in the Secure Freedom Fund is fairly low, somewhere around 60 to 65%. Each acquisition is a little bit different. One of the ways that we're able to generate the rate of return for our investors is underwriting and prioritizing for cash flow. So, as we're putting together our deals, we're looking not only for a favorable acquisition price, but for favorable financing as well. In the last couple of years, interest rates have been at a relative high compared to the several years before that. And so, one of the ways that we've been able to secure favorable debt in this portfolio is doing loan assumptions. So, we've done a Fannie Mae loan assumption, a Freddie Mac loan assumption, a HUD loan assumption. And the benefit of those loan products is they have much lower interest rates than if you get debt from, say, a local or a regional bank. So I mentioned at Villages at Essex Park, our interest rate on that acquisition was 2.18%, which is a HUD loan that's fixed for the next 37 years. Rainbow Plaza, which I showed pictures of, has a Fannie Mae loan assumption, which was 4.25% for the next 10 years. And then other assets have similar debt. We've not been able to do a loan assumption on every asset in the portfolio. I wish that we would be able to do that, but sometimes we do need to place local or regional debt as well. By having lower leverage in the fund, that allows us to generate more cash flow per month because the mortgage payment is lower per month. And that's one of the many ways that we think of as general partners of providing that level of security so that we can be as assured as possible of being able to make out the 10% rate of return to our investors.
Yeah. Now, when I think about a multifamily property, typically your cash on cash coming out of that is not 10%. I'm left wondering where the 10% being paid out to investors is coming from. Some of that's cash flow on the properties. You've never sold any of them, right? So it's not coming from sales of properties. Is some of that coming from cash out refinances, or are you just able to maintain that because such a significant portion of the investors are just reinvesting in the fund, and so that cash doesn't actually have to be paid out?
A little bit of all of the variables that you're mentioning there. So in the Secure Freedom Fund, we are really prioritizing our underwriting to pencil into a 10% rate of return. So doing that by having exceptionally good acquisition prices, because the market has been so soft over the last couple of years, we've been able to be much more competitive as a buyer than, say, compared to 2020, 2021, 2022, when the market was really hot. Part of it is the debt that we talked about. When you're able to get something like a 2 or a 4% interest rate loan, that obviously helps quite a bit with cash flow. Some of it is choosing to place a larger down payment. So in any real estate deal, regardless of the interest rate, the larger your down payment, the higher your cash flow, right? Because then you lower your monthly mortgage payment, which is typically the largest expense that a multifamily community will have. So we strive to pencil into as close to a 10% rate of return as possible from the monthly cash flow by working with those three variables. And then the ways that we can generate profit to service out to investors is from any of the profit that's generated from the portfolio. So that could be cash flow, could be equity harvesting from a future cash out refi, or equity harvesting from a future sale. So you're absolutely right. For those investors who are compounding, that frees up liquidity right now to be able to service out payments to investors who are choosing the monthly option. And then in the future, when we have a capital event like a cash out refi or a sale, that would inject liquidity into the fund, which then would have that liquidity available to be able to service out redemptions to investors who had been compounding for a number of years.
Okay, now on the multifamily property, a fund of multifamily properties, the expectations typically for a higher return overall than 10%, in the long run. What happens to any additional return above and beyond 10% in this fund?
So that's our compensation as general partners. So while I mentioned that we don't have acquisition fees or asset management fees or capital event fees or other types of general partner fees that are in the fund, the ways that we as general partners profit from putting together the fund is that after we service out the return to all of our investors, any of the upside that's left from the properties after that is our compensation as general partners.
Okay. And at what point is that compensation taken out of the fund?
So that would be taken out many years in the future, typically when there would be like a large liquidity injection into the fund. And so we would work closely with our counsel and accountants in the fund and making sure that the fund always stays net positive equity. So we would look at the value of the portfolio, how much debt was on the portfolio, how much investor capital was still placed in the fund, how much accrued return was had accumulated in the fund, and then anything that's above and beyond that we could redeem as general partner profit at that point.
But it could be taken at any time.
Correct.
Yeah. And
but we have to have net positive equity in the fund. That's a hard line that can't be crossed.
now, when property values can fall in the event that there's some terrible economic and real estate downturn, property values fall. At which point the fund could have negative equity in it. What are the regulations or rules in the fund should that event happen?
Yeah, that's a great point to bring up, because real estate it's not always linear, right? It's not always up and to the right. It's a jagged curve over time. So that would be a potential risk in the fund. That's one of the reasons why, as general partners, we would take the minimum amount possible and prolong the amount of time before we take compensation in the fund. So just as an example, the fund has existed for about 15 months and we've not taken any profit whatsoever from the fund. We're very much in the acquisition phase, renovation phase, stabilization phase. So even though the fund has many millions of net positive equity, and theoretically we could take general partner profit from that, there's not any plan, even in the next many years to take general partner compensation. And then we need to be thinking about, as general partners, always making sure that there's a margin of safety so that we don't run into that situation where, because we've taken general partner compensation, the fund has the potential of going into net negative equity in the future.
Yeah. And in a doomsday scenario where things are being liquidated to try to return capital to investors, what are the sources of that capital? Is it just the properties in the fund? Or is there a possibility of clawing back, profits that have been taken by the general partner? Or is there any other properties that are not in the fund that stand behind the investors' dollars? Or is it essentially they're limited to the properties that are still in the fund and the amount of equity in the fund?
So the fund is a standalone entity that owns the portfolio that we discussed here, that's going to continue to grow in time. We'll have more and more assets. And that's the source of collateral, of security in the fund. So it would be the cash flow, the equity, the sale of those properties that generates the return for investors, and then also the security for investors.
Now, investors are going to get a K-1 every year, and I presume they're going to get a Minnesota K-1 and need to file taxes in Minnesota. Will they need to file in any other states?
Correct. Minnesota only. Some of our portfolio in the broader Black Swan portfolio is in the state of Washington. No assets in the Secure Freedom Fund are in the state of Washington, and we don't have any projected right now in the state of Washington. But knowing that the Secure Freedom Fund will exist for many years, I at least want to present that potential to investors. One of the nice things about the state of Washington is there is no personal income tax. So no investor that invests in Washington has to file a personal income tax return there. So investors would only need to file at the federal level their own state of residence and then the state of Minnesota. So very simple tax structure in the Secure Freedom Fund.
Okay. And I know it's only been 15 months the fund has been going, but can you give us a sense for what people who invested last year are going to see on their K-1 this year? What percentage of their of the income they received would be covered by depreciation? How much of it would be capital gains, et cetera?
That number is a little hard to predict each year. So I'll share what happened in the fund last year. So last year, the amount of depreciation generated was about 40 cents per dollar. So if an investor invested $100,000 in the fund on their K-1, they would have $40,000 of depreciation allocated to them. I do want to caution that in subsequent years, that number can change quite a bit. The majority of depreciation in any given year comes from the new acquisitions that occur in that year, because that's when the fund can do a cost segregation study and do bonus and accelerated depreciation, which gives that big boost of depreciation all at once. The assets that are already existing in the fund that already did their cost segregation and their bonus and accelerated depreciation, they do continue to produce what's called straight line depreciation each year, but that's a much smaller number than the big boost that comes from an acquisition of that in that year. So in each year, the amount of depreciation that's shared out with investors is really contingent upon the number of acquisitions that we have in the fund that year, because we get that big boost from bonus depreciation. So it is a question that comes up quite a bit with investors, is how much bonus depreciation might I expect in any given year? And I caution investors that I can't really predict that at all. If, let's say, the market dynamic shifted and maybe we had way fewer acquisitions in 2026 than we did in 2025, that would change the amount of depreciation. Conversely, if we had many more acquisitions in 2026 and in 2025, that would also change the amount of depreciation that we're able to share out. We're generally able to get a fairly accurate assessment later in the year, say by like October, November of each tax year, because at that point we know the acquisitions that are happening in the fund that year. But I'll tell you that it's something we give a considerable amount of input in. We think about it a lot as general partners.
But so far, with paying out 40 cents on the dollar and a distribution rate of 10%, basically nobody's ever paid taxes on this investment yet, correct?
That's correct.
Yeah. And you talked earlier about taxes happening at long-term capital gains rates. I mean, the fund hasn't distributed any long-term capital gains because nothing's been sold, correct?
If investors are receiving distributions, because they as a taxpayer are receiving income, they're still having a taxable event. So even though the fund as a whole has not sold assets, the fund is generating distributions out to investors. So investors would have a taxable event. Now, the depreciation would cover the extreme majority or maybe even the entirety of the distributions that have already happened. Again, that's for the tax year 2025. In subsequent tax years, it's hard to model that because we don't know what our acquisitions will be. But our intent is that if someone is compounding, then they're receiving depreciation each year, carrying that forward, and then they have a taxable event when they have a redemption. If someone is receiving the monthly distribution option, then they would have income in that year, but the depreciation can be used to offset that income. I'll share just a quick little snippet about how much consideration we give to depreciation. Sure. Villages at Essex Park had a HUD loan assumption, and you may remember that in 2025, the federal government shut down for a number of weeks, and so that shut down HUD as well and halted that HUD loan assumption process. So it took a little bit longer to close on Villages at Essex Park than any of us had hoped for. We pushed and pushed and pushed to close on December 30th, which, as you can imagine, is a very challenging day to take over ownership and management of a multifamily community in the midst of the holiday season, immediately before rent is due on January 1st. Many residents are traveling away, kids are home from school, but we pulled out all the stops to make that happen so that we could get depreciation for our investors in the 2025 tax year, because depreciation is better sooner rather than later. If we had closed in 2026, and investors would have received that depreciation in that tax year. But that gives you some sense of the effort that we put into thinking about generating as many tax advantages as possible for our investors.
Okay. And what creditors are ahead of the investors in the fund in the event of downturn, et cetera? I mean, presumably the debt holders, whoever's loaning money on the properties, is ahead of them. Is there anybody else in between the debt holders and the investors?
That's it. That is the entirety of the capital stack. In many real estate deals, there's a very complex capital stack with all sorts of different investor levels. in that one acquisition. In all of the Black Swan portfolio, there's just the bank that holds the first mortgage on that property, very similar to a first mortgage that's held on a personal home, and then the investors, and then that's it. Across our entire portfolio, we've never had sophisticated or complex capital stacks. We think that prioritizes investors and it makes things very simple. And you never get into a situation where kind of group A has to be paid before group B, and then investors turns out they're group C, or all sorts of things that can happen when there's an opaque capital stack. We don't have any of that in our portfolio.
Okay. So is there a possibility that this 10% number could be increased or decreased at some point in the future?
The 10% is a fixed rate of return. So investors should think of that as the amount that we're projecting, that we're modeling for. It is important to note that investing in the Secure Freedom Fund is an investment, and all investment has risk. Sometimes investors will ask, is the 10% rate of return a guaranteed rate of return, right? They'll hear that fixed number, they'll hear the word fixed, and they might say like, well, how can you guarantee that rate of return? And I do want to call out that no investment has a guarantee. Really, the only financial institutions that can use the word guarantee are things like FDIC insured banks, the US Treasury. No investment is a guaranteed investment. So there is risk in the Secure Freedom Fund. Kind of the levels of risk that might be would be that we would need to suspend or pause distributions if the fund was low on liquidity. Next level might be that we're able to generate return for investors, but it's lower than the projected 10% rate of return. Next level would be that we're able to return capital to investors, but not generate a return at all. And then the worst level of risk would be a partial or total loss of capital. It's important for investors to know that. It's always important to think about the downside risk in any investment and what could go wrong in an investment. Across our entire portfolio, we've never failed to make a distribution. We've never lost money on a real estate deal. We've never had a capital call. We've never lost investor capital. So we model so that we feel very confident in our projections and in our ability to hit that 10% rate of return. But it is important for investors to know that all investing has risk.
All right. Well, let's see if we can sum this up a little bit. The real pros of this investment compared to other investments available to accredited investors is a relatively low minimum investment at $25,000, a relatively high income investment. If you're really looking for income to live off of or supplement your income, 10% is substantial. And that is, mostly tax-free for now and presumably tax advantaged in some way long term. Downsides, of course, you're taking equity risk. You've got the 10% return is essentially a cap. Return could potentially be lower than that. And of course, you have to file a Minnesota tax return at least once there is some taxable income being distributed there. Is that a fair summary, you think, of the investment?
I think you're a good student. You paid close attention. That summarizes it quite well.
Very well. Well, Elaine, thank you so much for putting together this presentation for us and helping people to understand what's available. And obviously, if people are interested in learning more, they can go to Black Swan directly. They can go to whitecoatinvestor.com/Black Swan and learn more about the investment opportunity available here. Thank you so much for your time.
Thank you for having me today.
The White Coat Investor Podcast is for your entertainment and information only and should not be considered financial, legal, tax, or investment advice. Investing involves risk, including the possible loss of principal. You should consult the appropriate professional for specific advice relating to